Hello, very good morning to all, and welcome to today's Daily Dose of Markets Insights. I'm Kelvin Wong here again. Very good morning to all. Today will be Thursday, the 8th of August, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Okay. Okay, so I believe that the screen is good. As well as any forecast, prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, just 1 second, just to make sure that everything is okay, so that the screen is clear, my voice is clear, and you guys can see my screen. Okay, so I believe that everything looks good. I mean, in terms of my voice, so it should be clear. All right, so let us proceed. So before we jump straight into today's intraday technical outlook, right? So let us now focus on firstly, what are the, we call it, performance that has taken shape in the yesterday's we call it US session, and as well as its we call it any potential news flow that actually impacting these prices of the various major cross asset classes. Then thereafter, I'll cover more of a longer term, medium term, put away that not really long term, more of a medium term perspective of the current ongoing fundamentals that I would like to share with you all that is taking shape, and as well as its intermarket dynamics on the potential impact on the major cross asset classes that we covered as well. So let's look at the performance of the US stock market first yesterday. So US stock market performance yesterday was rather, I would say that it's rather consolidation or a bit of profit taking after Tuesday a strong positive move up. Okay, so what you could see over here is that at the start is the movement of the US stock market was rather positive. It actually opened higher, and this is the S&P 500, and thereafter after 12 a.m. Singapore time, we start to see the profit taking shape, and it starts to shape an intraday sell-off and close near the low of the day. All right, so later I'll share with you more on the heat map of the S&P 500, but let me cover the intraday performance first. So S&P 500 down negative 0.77%, the Nasdaq 100 is down negative 1.16%, the Dow Jones down negative 0.6%, and the Russell 2000 down negative 1.4%. All right, so what we could see over here is that most market participants will start to question this. Is this the start of another globalized risk-off scenario in terms of the magnitude that we start to see late last week, then start to spread over dramatically on this Monday? All right, so the answer over here, share your based on this intraday performance on the heat map of the S&P, I would say is low probability. Why? Because if you look at the heat map over here of the S&P 500. Okay, let me close it, right? Good. Okay, why is it? Okay, let me refresh it again. Yeah, so if you look at the heat map of the S&P 500 over here, overall, it's rather a mixed bag. A rather mixed bag is we don't see an entire sea of red. There are still pockets of green here and there. And the main culprit that causes the drag yesterday was actually Nvidia and its fellow semiconductor stocks, right, which is down negative 5%, right, and it start to spread into the entire semiconductor sector within the technology sector. of the S&P 500. But the other remaining, we call it sector, there are still pockets of green, especially the financials. Not too bad. We do see some signs of positiveness in some of the key financial stocks, which is within the financial sector of the S&P 500. So net overall, we do not see a kind of a very dramatic risk-off scenario yet yesterday. And later I'll share with you some of the other we call it culprit that causes the drag on that global risk-off scenario. It's still holding on to some key levels that could still potential see this ongoing short-term rebound phase that is still potentially in progress for the major US stock indices. Later I touch up more about on this aspect of things, right? When I cover the technical outlook and the intermarket, we call it dynamics. And yesterday, FX market, what we could see over here is that the previous K-shaped performance, what I mean by K-shape, at the top over here, we know that during last week or prior to last week, globalized risk-off event, we have the K-shaped performance where the dollar is the strongest against those higher beta currency, which is dramatically related to the commodities market space, especially on growth-related commodities. That means we call growth-oriented commodities like oil and copper or iron ore. So that's actually more related to Aussie and the CAD. And indiscriminately, the Kiwi got impacted as well because of the close correlation with the Aussie dollar. So previously, there's this K-shaped performance at the top where the dollar remains the strongest against the Aussie, the Kiwi, and the CAD, the Canadian dollar, but remains the weakest against the safe haven currency, which is the Japanese yen and the Swiss franc. So what we could see over here is that this K-shaped dramatic movement has started to mean revert over here, which is also within our expectation for those who follow our daily dose since the start of this week. So we've been talking about this potential normalization. So this normalization phase has continues to take shape, all right, and also being kind of reinforced by the dollar yen strong push up yesterday. So this dollar yen strong push up yesterday was actually also triggered by a statement, a rather dovish statement from BOJ deputy governor, not Yuda. Yuda's the governor, is the deputy governor, the second man in charge. So he did mention in one of the we call it a Japanese press that now BOJ now got to be very mindful of the movement of the financial market. So he's pretty much concerned about the volatility in deciding their next step of policy, monetary policy normalization. That means what he implied to the market over here is that if the volatility of the market continues to spike up, that means it's a negative adverse impact volatility, like what we see late last week spreading on to Monday. BOJ may take a step back to further increase their short-term interest rate in the next meeting, which is in September. So that actually also causes the potential, we call it K-shaped performance to mean revert, where we start to see the dollar yen and the dollar Swiss starts to strengthen, and the previous dollar strong performance of the Aussie dollar and the Kiwi, the CAD, and starts to more or less evaporated. So all of them now is trying to trade according to a very tight mean level with the other rest of the major currency like the euro, and the sterling dollar. All right. So with that in mind over here is that the push up of the dollar yen and the push up of the dollar Swiss and the dollar strength dissipating against the Aussie and the CAD, that also should actually prevent any what I call a possibility of what that kind of dramatic sell-off in global equities, especially on the major US stock indices that we witnessed on late last week and as well as Monday. So that kind of possible movement has been reduced in terms of the current other intermarket asset classes that has a strong correlationship with them. All right, so that is yesterday's we call it kind of a important news flow event that takes shape and has its impact on the major cross asset classes that we monitor. Then yesterday there's no clear we call it no much of an important economic data on our calendar that we should be highlighting. So right now I will shift on immediately to the medium term fundamentals and the intermarket dynamics over here. All right, so now let me shift our focus now more on the gold market first. So we know that the gold market on Monday itself, there was a sell-off in the gold market. So the sell-off the gold market caused people to scratch their head why gold actually sold off. So by right, gold should remain rather supportive in light of this kind of risk-off or quite a synchronized risk-off aversion scenario over here. So the reason why over here is more or less related to quantitative funds, okay, fast money quant funds. So these fast money quant funds, I did mention somewhere earlier in our daily dose at the start of this week, this synchronized movement of the risk-off scenario in the market is more driven by systematic positioning, systematic fund flow positioning, and over positioning. So basically, it's all algo driven, okay, rather than fundamentals. So the fundamentals itself is more like reinforcement. We call it feedback loop trigger that magnify this very strong move on the downside. Unfortunately, it's on the downside because it's a one-sided bet taken by this fast money quant fund. So what they do over here is that they actually chase the momentum. All right, momentum. So what they do over here is that they got hit by the wrong side of the positioning in terms of stock, bond, and yen. And with the losses that's being seen on their stock, bond, and yen, most of them are being forced to actually cover their margin call or to maintain their whatever wrong position. They got to offset against their current we call it market winning position, which is in the long goal side of the story. So that's why some of these quant funds potentially trim off their so-called unrealized profit in gold, which they held on together with the other momentum chasing strategy, because gold is also on a uptrend. Okay, it's only that this uptrend is not as pronounced as the uptrend that is being seen in the Nasdaq 100 or some of the mega cap technology stock that is moving up at a faster pace. So perhaps a lot of heavily position is being leveraged on this higher momentum factor, which is primarily focused on the mega cap technology stocks, not so much on the gentle and the smooth uptrending gold price. But gold price got hit as well because of their erratic move in their extreme positioning in the mega cap technology stock that causes them to get margin call or whatsoever. Gold unrealized profit, their unrealized profit got to be trimmed off in their position, so that actually causes a negative cascading impact in gold price on Monday. Okay, where was it? Yeah, so you could see over here. Okay, so on Monday there's this slide down. Okay, because so this was the Monday sell off. Then the next key step over here, we got ask ourselves, this Monday sell off, is this justifiable from a medium term perspective? Because it's just a 1 day sell off, will it lead to a crash in the gold price? Then we got to take a step back to look at their medium term intermarket dynamics that is still supporting this ongoing major uptrend in gold since the low of 9th of October 2023. So one of the clear fundamental intermarket dynamics is to be bullish on gold price. That means in order for gold price to keep on shaping higher high, trading in this major uptrend dynamic, we got to see supporting factor of lower cost of holding. So we know that gold is different from bonds. Any bullish we call it positioning on gold, that means we held it for a very, very long term. We talk about years. Gold do not give you any interest bearing income asset. That means it's not like your bank deposit or your bonds where you have a long positioning in bond for a very long term, you get fixed periodic bond coupon. So that's considered like a fixed income. So that's why bond is being deemed as a fixed income, because there's a constant stream of coupon payment being paid to long-term bond holders. But unfortunately for gold, if you hold it for very long term, it's a non-interest bearing asset, no fixed income, no nothing. The only way to benefit for gold is continuation of a potential further appreciation in gold price. So one of the reasons gold price could actually appreciate stronger is opportunity cost. That means we need to look at other assets classes that is competing money flows for gold, and one of them will be the bond itself. So we know that bond price and the yield move indirectly. All right, so yield, ticket of the yield itself is like a interest income, or put away that this yield is something like a interest that investor get if placed into a fixed deposit. This is make it as simple as possible. So if you look at the top of this particular chart over here, I overlaid with that gold price. So we know that this gold price that is starting its major uptrend since October 2023 has been moving in line with a downward move of this US 10-year Treasury real yield. So I make it much more economically sensible by minusing off the interest inflation expectation. So it's a real yield. That means I remove off the inflation expectation component. So what we could see over here, since it's almost synchronized bit by bit, the low price of gold, the major low of gold for 5th October correspond to the current major peak of the US 10-year Treasury yield. Then ever since the US 10-year Treasury yield keep going downwards, lower and lower, what we could see over here is that the gold price also keep going up. All right, and this particular spike down in gold correspond to the bounce off the 1.62% medium-term swing low of the real 10-year US Treasury real yield at the 1.62%, which is the medium-term swing low of 27th of December 2023 to 1st of February 2024. And what we could see over here right now, the prices of it still continues to trade within this medium-term downtrend because it's still trading below the 50-day and the 200-day moving average. All right, which is now forming a key medium-term resistance zone at the 2%/2.07% level. So net overall, the medium-term trajectory of this we call it a US 10-year Treasury real yield is more inching downwards to the downside rather than the upside right now. All right, and that could actually also further support this ongoing we call it major uptrend in gold, and as well as a medium-term uptrend in gold. Why? Because it's still bouncing off the 50-day moving average that is still holding above it since the breakout that has taken shape on the week of 3rd of July this year. All right. So net overall, intermarket dynamics are still supporting the ongoing medium-term uptrend and the major uptrend in gold price. Okay, this is something that I'll share with you all. And still recall that Nikkei 225 is also one of the major domino, the later part of it, that causes that global synchronized risk-off impact that was seen, risk-off or not risk-on, risk-off impact that was seen on Monday because of its dramatic fall on the Nikkei 225. Then I also share with you all the Nikkei 225 that we now starts to see a potential bullish key reversal week for this week. This is a weekly candle. Now it's forming a dragonfly doji. You got to wait until tomorrow, which is just one more day, whether can it maintain such positiveness that we see. So this is only purely on the Nikkei 225 price action. But how about other intermarket dynamics to actually support this potential key bullish reversal week for the Nikkei 225 that is still in progress? We'll be taking a look at this particular intermarket dynamics. Okay, take a look at it at the bottom. Okay, at the bottom is your Nikkei 225. This is on a weekly time frame, so it's a longer term or medium term horizon. Ignoring those, intraday whipsaw here and there. The top of this chart is the yield spread between the JGB 10-year yield minus the JGB 2-year yield, and the longer term, the JGB 30-year yield minus the 2-year yield. You realize that all these three charts are moving in a direct synchronization. Previously, once we start to see this push up in this 2-year spread, the JGB yield spread, your Nikkei 225 also starts to shape a series of higher high, higher low, and continue this major uptrend phase, right? That is in place since the pandemic low. All right. So this was that dramatic sell. This is closing price also. That's why you were not able to see that key reversal hammer when we switch over to the candlestick chart. So this is a daily closing price. After that dramatic fall over here, we realize that now the 10-year JGB yield spread and the 30-year JGB yield spread also fall as well. It fall as well. But right now, both of them are trying to rebound off their key major channel support level. All right, both on the 10-year yield spread against the 2-year and the 30-year against the 2-year, which is bouncing at a much more dramatic pace. Why? Because it actually surpassed Monday's high, previous high that actually corrected this dramatic fall. Okay, so this dramatic fall also linked to that dramatic fall in the Nikkei 225. And given that all three of them move in a strong synchronization, and this guy now is leading to form a higher high, there's also a very strong likelihood that whatever low that we see in the Nikkei 225 this week is a potential key reversal low. That means, i.e., there's a high probability based on the price behavior of this intermarket relationship between the GGB yield spread and the Nikkei 225 that is taking shape right now. There is kind of a higher probability that the Nikkei 225 major uptrend phase still remains intact. All right, good. So these are the current key, we call it longer term or medium term fundamentals and intermarket dynamics that is actually taking shape right now at this juncture, which I find it very interesting that I like to share it with you all. Okay, so now with that, that would actually covers the intermarket dynamics for today. And now I'll shift our focus now to the short-term intraday technical outlook on the major cross asset classes, starting from the FX market. All right, so with that, let me expand my screen so that you guys could see the chart and the key levels much more clearer. Okay, so starting with the euro dollar first. All right, so for the euro dollar, still no change. The price action still continues to trade sideways yesterday after our initially expected push down that we highlighted on Monday's daily dose. All right, so on Monday daily dose, we do have a bearish bias. Why? Because price action can't actually break above the medium term symmetrical triangle resistance despite an intraday push up. So this is what I mean. If you go to the daily chart, for those who are seeing this for the first time, but for those who already seen it again, just bear with me for our new audience who see it for the first time. Overall, from a medium-term trend perspective, since the high of 18th of July 2023, euro dollar is still trading within this symmetrical triangle sideways range. And last week price action managed to push up the top of the on Monday price action. On Monday price action Monday, it managed to push up to the top of the symmetrical triangle. Yes, intraday it hit a high, that's our resistance, but at the end of the day, it did manage to close above the upper boundary of this symmetrical triangle resistance. So i.e., there's still a risk right now for the euro dollar to do a kind of a mean reversion decline towards the middle part of this symmetrical triangle range configuration that is in place since July last year. Okay, now back to the daily, the hourly time frame chart for today. So for the hourly time frame chart, since yesterday it just traded sideways, I will not change the short-term pivotal support level that we have yesterday at 1.0965. So what's 1.0965? You recall, if I take this current push down, means from Monday intraday swing high all the way down to the low of Tuesday's minor swing low, it corresponds to the golden ratio of 61.8% in terms of the Fibo retracement, also acting as a resistance, that potential resistance level at around this 1.0965 as well. So as long as price action didn't surpass 1.0965, will still remains a intraday bearish bias on the euro dollar. First support level to watch on the intraday basis, 1.0895. Below it exposes 1.0870. We also correspond closely to the 20-day moving average as well. Okay, only an hourly close above 1.0965 will invalidate today's intraday bearish bias, not bullish bias, pardon me, invalidate today's intraday bearish bias to see a retest on this Monday high at 1.0990/1.10 level, psychological level. A breakup above it potentially may see the next near-term resistance zone coming in at 1.1060/1.1080 next. Okay, sterling dollar. So sterling dollar continues to trade lower as expected. Is actually having a much more pronounced intraday downside momentum as compared to the euro dollar at a very short-term juncture. Why? Because it continues to hover within this minor descending channel that is in place since 17th of July. All right. So no change. Yesterday we do have a very tightened key short-term pivotal resistance level. Price action indeed bounced, and there it shaped a bearish reaction. So this is indeed a key resistance level in order for the best to maintain its downside momentum on an intraday basis, because they actually reacted right exactly yesterday, all right, from this level that's been highlighted earlier on. So still no change, 1.2740 short-term pivotal resistance level to maintain our intraday bearish bias on the sterling dollar. Near-term support level to watch will be at 12660, which is close to the 200-day moving average. Below it exposes 1.2620, which is also the lower limit of this descending channel, which is the minor swing low area of 21st of June to 3rd of July. And a breakdown may see a further acceleration on the downside to expose 1.2590, 1.2580 level next. Only a price push up with an hourly close above 1.2740 will invalidate today's intraday bearish bias to see a push up towards to retest the upper limit of this channel again at 1.2780, which also correspond to the 50-day moving average that is acting as a resistance as well. Only an hourly close above 1.2780 that could actually increase the odds of a mean reversion rebound to retrace some of the decline that has taken shape from the high of 17th of July to all the way to the current swing low of 6th of October. That may expose the next near-term resistance level at this 1.2830, 1.2890 next, which will correspond to the 20-day moving average closely that's acting as a resistance level as well, at very close to 1.2890 level. Okay, so with that, that sum up the intraday technical outlook on the European currency. So let us shift our focus now on the Asia Pacific dollar pair, starting with the Aussie dollar. So Aussie dollar going to push out with our expectation during the late Asia session at around 4 p.m. yesterday. It hit our first resistance zone at 6560/6580 before tumbling down during the US session, and right now it managed to shape another higher low right at the start of today's Asia session and form a bullish hammer. So with this positive movement seen on the intraday basis, we will have a tightened short-term pivotal support for today at 65 figure level. So as long as 65 figure level didn't break down on the downside, still maintain that intraday bullish bias on the Aussie dollar. Above 65.80 exposes 66.10, 66.30 level over here, which is so close to the 50-day moving average, acting as a resistance level as well. Only a price break below 65 figure level will negate today's intraday bearish bias to see a push down again to retrace a portion of this we call it push up level from the medium term pivotal support level at 65.30. So the next near term support level to watch if 65 figure is being taken out on the downside will be 64.70 followed by 64.35 level, this level here. And if you do the Fibo retracement of this ongoing push up, taking into account of yesterday's intraday high, that should give us the golden ratio as well at 64.35 level. All right. Now, with that, let us now shift our focus to the dollar yen. So for the dollar yen continues to push up as well, okay, within our expectation and almost hit our first resistance level at 14850 before trading much lower, all right, during the US session. And today, Asia session, it managed to actually shape a bounce. And this bounce also saw a bounce on the RSI over here at some parallel support level. Okay, let me highlight. Okay, some parallel support level over here, and indicating that there is still some form of short-term intraday bullish momentum that is still intact for the dollar yen. So with that, no change. So in fact, what I can do is we could actually use today's low here, which correspond to this minor swing low. This will be my first support level to watch, 14540, but it's a bit tight, so I'll still use 14350 level as my key short-term pivotal support level. No change from yesterday to maintain this intraday bullish bias on the dollar yen. Above 14850 exposes this 151 figure level, 15170, which is rather key in terms of a short-term resistance perspective. Why? Because it corresponds to two key different elements that is pointing to the same level, the 200-day moving average acting as a resistance, and as well as this descending trend line from the high of 11th of July. All right. Only an hourly close below 14350, that means a breakdown of the hourly close below 14350 will invalidate today's intraday bullish bias to kickstart another round of so-called impulsive down move, potentially to retest 14160/40. A breakdown below it may see further potential reinforcement of the continuation of the short to medium term downtrend phase of the dollar yen to expose the next support level at 140.25 followed by 139/138.10 next. Now, that covers the intraday technical outlook on the major FX crosses. Now let us touch on the major stock indices, starting with the Asia stock indices, which is the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index over here is that, yeah, for today, it managed to actually now try to hit our resistance level. It broke above this level over here. So with that, given this strong push up right in the last 2 hours, this was yesterday first resistance at 16,970. Okay, so given that it is broken above this level, we could actually still have a short-term bullish bias, but much more conservative one, taking into account of this strong V-shaped move up over here on the intraday basis. So this will be my key support level to watch. All right, so let me push this down. Okay, this will be 16,650. Okay, so this will be my short-term pivot level. Okay, so as long as this 16,650 short-term pivotal support holds, we'll still maintain that short-term intraday bullish bias on the Hong Kong 33 or the Hang Seng Index for this continuation of this short-term mean reversion rebound scenario. Next short-term resistance level to watch on an intraday basis will be 17,185. That confluence with the 200-day moving average as well. Above it exposes the next near-term resistance on the intraday basis, 17,410/17,517, which also correspond to the downward sloping 20-day moving average as well. So, but however, if price action continues to instead hitting on the upside, but it starts to come down and break below 16,650, then potentially it will be transformed into a kind of a range bound scenario again for the Hong Kong 33, retesting the range support that was being formed on Monday at 16,460. So only a breakdown with hourly close below 16,460, then we will see the start of another leg of impulsive down move to actually expose the next the next support zone of 16,130, 15,960 level. If you go back over here, it's actually this congestion zone here, right? From 19th of February all the way down to 19th of April this year. Okay, so that sum up the intraday technical outlook on the Hong Kong 33. Now let us focus now on the Nikkei 225 or the Japan 225. So my apologies, I think yesterday I skipped the Japan 225, but the level still remains the same over here. So with that, price action hit the Nikkei, the Japan 225 at the first resistance level that we highlighted on Tuesday at 35,755 before doing that retracement again over here. So with that over here is that because of this ongoing high volatility in the Japanese stock market, so I don't want to put it so tight. So this could be my first support level to watch, which is at 33,960. But as long as any potential pullback, because it also haven't break above the 35,755 yet, any potential pullback that didn't break above the earlier short-term pivotal support level that we highlighted, 32,710, we will still maintain that we call it a current short-term bullish bias on the Nikkei 225 or the Japan 225 above 35,755, exposes the next near-term resistance level at 36,885/37,480. Above it, re-exposes the 20-day moving average and also close to the 50-day moving average, all converging at this graphical resistance level of 38,430. Next, only an hourly close below 32,710 will invalidate today's intraday bullish bias to see a retest on this Monday low at 31,400 and even potentially the long-term pivotal support at 30,170 next. Okay, the European indexes, the German 30. So for the German 30 over here is kind of the weak right now in terms of the technical configuration that we are seeing. So the German 30 yesterday we do have a bullish bias, so it actually went up, but almost hit the first resistance level at 17,730 that we highlighted before trading on the downside throughout the US session, into the close of the European session, from the close of the European session and throughout the remaining part of the US session. So from a technical perspective, it seems to have this minor bearish breakdown, okay, of this kind of, we call it bearish pennant or configuration. All right, so with that minor bearish breakdown of this pennant configuration, potentially it could see a bit of weakness coming into play. So with that, I will use the upper limit of this breakdown, this pennant bearish pennant breakdown now turns into a pullback resistance level, which is also my short-term pivotal resistance level for today, 17,565. So you look at 17,565, if I take the Fibo retracement of this push down from yesterday's intraday high all the way down to the US session low, it also corresponds to the golden ratio of 61.8% as well. Okay, let me put it brighter. Okay, 61.8%. All right. So with that, as long as this short-term pivotal resistance didn't surpass on the upside, that means there's no hourly close above it at 17,575. We will flip to a short-term intraday bearish bias for today on the German 30, i.e. the German DAX. Near-term support level to watch, firstly, will be at 17,250 level, which is this minor swing low area of 6th of August. Okay, this level here, only a breakdown below this level, potentially revisit this Monday's swing low at 17,030. All right, only got to break down below 17,250 level. All right, then we expose 17,030. But if price action instead goes up and break above this 17,565, then this bearish breakdown scenario will be invalidated already and may continue to see the rebound taking shape on the German 30. Next resistance to watch 17,730. Above it exposes 17,960 next. Okay, for the German 30. Now with that, let us focus now on the major US stock indices, starting with the Dow Jones Industrial Average, i.e. the US Wall Street 30. So the US Wall Street 30 yesterday's continued to rebound at the start of the European session and retest the first resistance that we highlighted, 39,480, before shaping that intraday sell-off and back again to our short-term pivotal support level at 38,3775. So no change, we still use that 38,3775, 38,375 as my, okay, let me remove this, okay, 38,375 as our short-term pivotal support level to maintain this intraday bullish bias on the US Wall Street 30. But we need to have to increase the probability of that potential short-term intraday bullish bias. It got to actually clear above this first near-term resistance level at 38,920. Okay, this line here, 38,920. Then we potentially the bullish bias probability may increase to see a retest at 39,480. Above it exposes 39,845 next. But however, if price action starts to break down below 38,375, we also now correspond very closely to the 200-day moving average, then we should potentially see the continuation of another impulsive down move to actually expose the next near-term support level in first step at 38,030, 37,760, followed by 37,380 next. Okay, which is the key medium-term swing low of 19th of April. Okay, so that's for the US Wall Street 30. Moving our focus now will be on the Nasdaq 100. So the Nasdaq 100, yesterday it hit our first resistance again, almost very similar to the Dow Jones Industrial Average before that sell-off take shape. All right, so this sell-off taking shape managed to actually help exactly at the 200-day moving average, which is also a positive element or a positive sign. So no change. This will be my short-term pivotal support level, which is on the same as Monday or on Tuesday as well, and even on Wednesday, 17,400 / 17,310 short-term pivotal support level for this ongoing mean reversion rebound to actually continue. It got to actually break above the near-term resistance at 18,010 level. Okay, this level here above 18,010 sees a retest of 18,400 before 18,680 near-term resistance level to watch. All right, only above 18,680 may see 19,230 next, which is corresponding to the 20-day moving average. That is at 20-day moving average that's acting as a resistance level as well. But however, if price action starts to break down below the 17,310 level, then the impulsive down move may resume, exposing the next support area at 17,160, 16,930, and potentially even 16,600 next. All right, so that sum up the intraday technical outlook on the major stock indices. Let us now focus our attention to the commodities, starting with gold XAU / USD. So no change for gold. Gold continues to remain trapped right now in a minor symmetrical triangle range configuration that is being depicted in the purple line here, and right now it's trading very close to the lower limit of this symmetrical triangle range configuration, where its lower boundary is now acting as a support level at the 2,370 mark, also corresponding to the upward sloping 50-day moving average as well. All right, so this is indeed a key support level on a short-term basis. So as long as 2,370 short-term pivotal support holds, we still maintain that short-term intraday bullish bias for a potential push up towards the upper limit of this symmetrical triangle range symmetrical triangle range configuration. Again, first resistance to watch will be at 2415 level. Above it exposes 2457, 2470, which is the upper limit of this symmetrical triangle range. Only an hourly close below 2370, then was potentially trigger a bearish breakdown from the range, exposing the next near-term support level in the first step on an intraday basis at 2353, followed by 2336 next. Okay, so that sum up for gold. Now let us focus our attention to the West Texas crude oil. So before we go to the intraday chart, on the daily time frame, just give you all guys a bigger picture refresh again. Overall, for West Texas oil gold since 20th, West Texas oil, not gold, pardon me, West Texas oil, overall is still trading within a medium-term symmetrical range triangle symmetrical triangle range configuration since the low of 20th of March, okay, by depicting by this gray line here, this upward sloping gray line and the downward sloping gray line. And what we could see last week and Monday sell-off managed to actually help exactly at the lower limit of this symmetrical triangle. So potentially right now, after that bullish key reversal day that was formed on Monday, and we do have a positive follow through finally on Wednesday that surpassed the high of the key bullish reversal day on Monday over here. Okay, let me maybe draw it in line so that you guys could see. Okay, so this is the key reversal day high on Monday. Yesterday it has a daily close above it, so it increased the probability right now that this could be an ongoing short-term rebound phase that's unfolding at least back into the first half, or potentially into the upper half of the symmetrical triangle range configuration again. All right, so with this positive daily price action that's being seen on yesterday's West Texas crude oil price chart, we will still maintain our intraday bullish bias on West Texas oil. But for today, we do have a tightened key short-term pivotal resistance, pivotal support level, given that the first resistance level has been surpassed at 75.46. All right, so we tighten our short-term pivotal support for today, 74.70, to maintain our intraday bullish bias on West Texas oil. Next near-term resistance level to watch, 77.22, followed by 78.40, which confluence with 78.46, pardon me, which confluence with the 20-day and the 200-day moving average. Above it, may see a retest of the minor swing high of 26th of July and 1st of August, acting as a next near-term resistance at 79.65, which will confluence with the 50-day moving average as well. Only an hourly close below 74.40, then we'll see a retest of that medium-term range support level, which is the symmetrical triangle range lower limit at 73.15/72.24 level. All right. So with that sum up the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the calendar, the economic calendar, to highlight to you guys what are the key data to look out for today. Okay, so today will be the Thursday over here. Okay, so for Thursday over here is that during the European session, nothing much to actually look at it. So for those who actually, yeah, this one may have into attention, may come into our attention right now, attention by the market participant because of last Friday, very weak non-farm payroll data. This is more like a weekly jobs claim data, much more noise rather than the monthly NFP figure. So but market will still pay very close attention to this level. So if there's an increase in this initial jobless claim and as well as a cumulative continuous jobless claim figure, much more than consensus that's expecting, which is 240k and 1870k, potentially we may see a bit of a negative knee-jerk reaction to the stock market. Okay, so something to take note of at 8:30 p.m. Singapore time. This is the US weekly initial jobless claim and weekly continuous jobless claim. All right, then thereafter is a rather quiet session, except that we do have one key official speaking, the Federal Reserve official speaking at 3 a.m. Singapore time tomorrow. Okay, Fed baking that's speaking. So that is for the economic calendar. As we know that tomorrow is Singapore public holiday, which is Singapore National Day. So I wish you all a restful and happy National Day. And tomorrow there'll be no daily dose, and as well as do have a restful weekend as well. And we shall speak again on next Monday. All right, here, Kelvin here signing off, and happy National Day. Thank you.